In the initial stages of our journey, we want capital growth. Maybe towards the end, we could transition to something like this. So these markets, they had a good run between 2016 to 2022. That means that the job market is good. If the job market is good, people are getting healthy incomes. If they get healthy incomes, they have money to buy property, and therefore I know. Thinking of buying your first investment property in 2025? Here's the truth. Most markets in Australia are now starting to move up. So only some of them are going to be performing over the next 5 to 7 years, while some of them are going to slow down again. So if you've got 550,000 to start with and you're looking to invest in property this year, then this video will show you what to look for, what to avoid, and how to correctly approach buying an investment property in 2025. Hi, for those of you who don't know me, my name is Jadu Srikandan. I'm a buyer's agent for property investors, and I buy properties all around the country using a data-driven approach. So if you want to work with me, then go to my website propertyframeworkbuyersagency.com.au and book a session with me there. I want to talk about the fundamentals of buying investment property in 2025. So if you are someone who's looking to buy their first property and you want some guidance on how you should approach this, what you should buy, what you should not buy, where you should look at, where you should avoid, then this video is for you, because I'm going to give you that blueprint of how you can get started investing in property in 2025. So let's get started with this. Let's start with the basics. What are we looking for? We're looking for freestanding houses on decent sized blocks of land. So we are looking at least 500, 600 meter square blocks of land. Let's talk about what we should be avoiding, because as a first time investor, there can be several distractions that come in, and we should not be getting caught up with these distractions. I'll give you some examples here. So the first one is buying apartments in capital cities. When you're priced out of the property market, or you're priced out buying in your own capital city, you tend to buy apartments in that same region. This is an example of an apartment in Toongabbie in Sydney. This sold for $525,000 recently. But if you look at this, 2025 it sold at $525,000, but in 2017 it sold at $605,000. So it must have been built around 2016, 2017, and then it's gone down in value by nearly $100,000 over a period of around 8 years. During that same time frame, 2017, if you had bought into maybe another market instead, for example Hobart, which was just starting a growth cycle, a 200,000-300,000 property would have been like 600,000-700,000 now. You could have more than doubled your money within that same time frame. I know there are some people who argue that yes, apartments are picking up now. There are certain pockets where apartments are picking up. Look for the low-rise apartments and stuff like that, right? So yes, there could be some value in the short term, but over this longer term, houses are going to outperform. So always buy freestanding houses on decent sized blocks of land. The next one is some investors, when they start off, they think about cash flow. They want to buy properties which have granny flats. They want to buy properties which have dual income potential. Now, to me, that's not a great strategy. When we're starting out our investment journey, our focus is mainly on capital growth. We want to buy that standard asset which appeals to the broad market or the mass market. We don't want to buy these investor type of stock, the stock that can only be resold back to an investor, because none of the owner occupiers are going to buy something like this. They don't like properties with granny flats. They don't like these dual income properties. So we want to buy the standard brick and tile homes that appeals to the mass market when we are starting out our investment journey. For example, this one, you can see the price point itself. This is in Townsville in Gulliver. The price point itself is fairly high, $780,000. It's a dual income property. It has a rental yield of $840,000 per week. But I would use my borrowing capacity, instead of going all the way to $780,000, look to buy something under $550,000, preserve my borrowing capacity and use it for other properties instead of buying some expensive dual income asset. Even though the cash flow is better, we're not all about cash flow. In the initial stages of our journey, we want capital growth. Maybe towards the end, we could transition to something like this. So don't make the mistakes of buying high cash flow kind of assets towards the beginning of your investment journey. Now, the next one is buying properties on very small blocks of land, new properties. I know it's very tempting to buy newer properties that look perfect, that look really nice, that need no maintenance on these small blocks of land. So this one is in Truganina in Melbourne. It sold for for 620,000, but it's only a 273 meter square block of land, right? So for this property, you can see, if I show you the photos, it looks really nice inside. It's beautiful. You would see that around 500 to 550,000 of the value of this property is going to be in the construction, and a very small portion is going to be in the land. And therefore, again, coming back to the old principle, land is the one that appreciates, building depreciates. We want something on a decent land component. So I would avoid newer properties on these small blocks of land. And then as a first time investor, sometimes you might think, oh, I should do a development project. That's where I can make a lot of money. Don't try anything too risky at the start. We don't want to do that. We want to go into those once we are a bit more experienced. So unless you really have the knowledge about development, we don't want to start with development projects at the very start. We want to keep it very simple, and we just want to buy the standard asset. We've spoken about what we want to buy. The next thing is the cash flow. What are we typically looking for in terms of cash flow? So let me tell you, in 2025, a 4.5% rental yield is perfectly normal. We don't need to chase 6-7% or higher than that rental yields. Because prices have moved up in most parts of Australia, yields have compressed, and therefore this 4.5, as long as you're buying into a market which has the solid fundamentals, you'll still be okay. You just have to be bearing in mind that a property that you buy for 550,000 would be negatively geared by around 10,000 to 15,000 per annum in your first year. That of course improves over time, but you have to be okay with that negative cash flow. While your property is negatively geared, if you buy in the correct market, you would see that it's moving up by around 50,000, 60,000 per annum. So we are investing for capital growth. We are not too focused on rental yield at the very start. But of course, we still need a healthy rental yield of at least 4.5%. I'm not asking you to buy anything lower than 4%. That type of yield should be completely avoided, but around 4.5 and a bit higher is perfectly normal. And that's the norm in 2025. Now, we've spoken about what type of asset we're looking at. We've spoken about the cash flow. And now the big question, where are we going to buy? In 2025, I can split Australia into three different groups. I'm going to group them by the phase they are in their growth cycle. When we are selecting the area to buy, we look at two things. So one, which phase are they in their growth cycle? And number two, does this market, like even though it's early in the growth cycle, does this market meet the fundamentals? So those are the two things that we are looking at. So coming back to the phases, right? I can split Australia into three different phases, okay? The markets such as Queensland, Western Australia, South Australia, they've actually started growing from around late 2020, and they're well into the growth cycle. 5 years of solid growth of around 20% per annum over the last 5 years. Whether you look at the capital city there, whether you look at regional markets, whether you're looking at the small towns, you would see the exact same pattern in all these three states. So these are markets that are well into the growth cycle. Then we have a second type, which we find in Victoria and Tasmania, and maybe even parts of NSW. I'm talking mainly about regional markets here, and maybe even capital city markets. So these markets, they had a good run between 2016 to 2022, and then between 22 till about 25, they stagnated or corrected or went down in value. And now they've started what we call a second phase of growth. So that's the second type of market that we're seeing. And then we have the third type, and that's the one where it's had a long period of stagnation for like 10-15 years, and it's now just started a growth cycle. And that of course is Darwin in the Northern Territory. Now, whether or not we buy in Darwin is a totally different story. Back to point number 2 that we're going to talk about, which is the fundamentals of the region. Does the market have the fundamentals of the region? So we know that we have three different groups here. Where are we going to buy? We wouldn't want to go into a market that's late, pretty much well into the growth cycle, because we know the growth is going to somehow slow down in the next 2 or 3 years. Maybe there's a correction coming. There's going to be slower growth coming ahead. We would ideally want to go into markets that just starting their growth phase, so Darwin, or we would go into markets that are starting their second wind. So markets like regional markets in Victoria, regional markets in Tasmania, Hobart, regional markets in NSW, these markets. It makes sense for us to go there. Now let's talk about Darwin. Darwin is kind of early. It's getting pumped up and prices are moving up, but does it have the fundamentals? And that leads me to what fundamentals are we going to look for? And this is the most important part that sometimes investors can miss, because we can find markets that are early in the cycle. We can go and buy into these hotspots. But then if we don't really go deep and assess the fundamentals, then we might be buying into the wrong area. In terms of fundamentals, there are 4 main points that we look for. So one is the population. We want at least 20,000 in population, and we want the population to be moving up slowly. Now, if you look at Darwin's been losing population. That's not a good sign. The next thing is the unemployment. We want the unemployment trends to be dropping. We want them to be in line with the national averages. That means that the job market is good. If the job market is good, people are getting healthy incomes. If they get healthy incomes, they have money to buy property, and therefore I know my property investment is going to be good over the short to medium term. So I want areas with lower unemployment rates, or at least signs showing that the unemployment rates are dropping. Then the third one, and it's the most important one, I want to get into markets that are diversified economically. So what do I mean by that? Some of the hotspots that we're looking at recently, right? So areas like Gladstone, Mackay, Perth to some extent, Geraldton, all these markets, they are reliant to some extent on the mining industry. That means they are less economically diversified. And that means that there could be chances that when the mining industry goes through a downturn, property prices could drop in these areas. Okay, so there's that risk over the long term. And then we have markets that are fully reliant on mining, like Port Hedland, Karratha, Moranbah. These type of markets we know for sure are going to be volatile. They can go up in value, and then property prices could drop at any time. So there's a huge risk in going into these markets. So ideally we want markets that are diversified. We have healthcare, we have retail, we have manufacturing, we have construction, public administration, we've got government jobs, we've got all those type of things. We want to look for those type of markets like Ballarat, Geelong, Bendigo, Townsville, Albury. These are the markets that are well diversified, and they function as very good long-term investments. Okay, so we want to look at that diversification element. And the last one is the infrastructure projects. So does the region have big infrastructure projects coming up in the future? For example, new hospitals, new universities, new transport infrastructure, road, rail connectivity. That becomes really important because that's going to change that area. People will want to come there, jobs will be created, and that will affect the property market directly. Okay, so we want to look at these 4 fundamentals when we are assessing a region. So we want to look at where it's in the growth cycle. Okay, that's done. Okay, I know it's early in the growth cycle. I've selected a market that's early in the growth cycle. But now I also have to go back and check, okay, does it meet all these fundamentals? Is it going to be a safe investment over the long term? If you are someone who's willing to take a bit more risk and you understand market cycles, then of course you can buy into less diversified markets. You can buy into these smaller markets as long as you understand what you are doing. But for someone who has no time to research these things, you would want to stick to a very diversified, low risk market. That's how you select the markets. And once you narrow down the markets, then it's a question of finding the right suburbs. It's a question of finding the right properties, those type of things, right? So I've done videos on how you find the right suburbs. I've done videos on how you find the right properties, the factors that you need to look at when you're buying the right properties. So have a look at those videos, and that will give you some idea, right? So that's it, guys, for me for this video. This was just a very overview or exact blueprint of how you could get started in investing in property. And this is exactly what we do with clients, right? We talk to them about their goals, their requirements, and then we go through these points with them, how these markets are positioned in their cycle, whether it's a long-term investment, whether it's a short-term investment, are these markets risky, are they volatile? And we cover all those things when we discuss the strategy with the clients, right? So if you're someone who is time poor, does not have the time to do this type of thing, get in touch with me and I'll walk you through the entire process of how you should select the correct market and buy the right property for you. Hope you found it useful, guys, and I'll see you in my next video.